What's up everybody, I am Jaspreet Singh, and in a not so happy turn of events, Russia has declared on their state media TV that World War III has started and that Russia is now at a full-scale war with NATO in this new world war. Obviously here in the Western world we have different opinions on what's going on with the war, but this has me wondering, what's going to happen if we do see a World War III? The biggest cost of any war is not any financial cost. It is the cost of all the innocent lives that will be lost, and there's no price that you can put on that. But what I want to do today is talk about something a little bit different. I want to talk about what would happen to something like the stock market and our investments if we did see something like a World War III. And the way that I want to do that is by going through a historical analysis, talking about what happened to the stock market in World War I and then World War II. That way we can get a better understanding of what could potentially happen if we were to see a horrific, I mean this would never be a good thing, but if we were to see a World War III happen in our lifetime. What's kind of funny to me is I never liked history until I didn't have to take a history class, and World War I was fought between 1914 to 1918, and this was between the Central Powers, Turkey, Germany, Austria-Hungary, versus the Allies. The Allies in World War I were France, Great Britain, Russia, Italy, Japan, and then later on the United States. The last thing that I want to say before we get into the finances is the US joined the war in 1917. So leading up to the war in 1914, the United States stock market wasn't doing so hot. The war officially started on July 28th, 1914, and between January of 1913 to July 30th of 1914, you're going to see why these dates matter in just a second, the stock market in the United States was down just around 20%. So the stock market has entered bear market territory, and then the war starts, and then on July 31st, 1914, just a few days after World War I started, the stock market shut down because we had hit a circuit breaker. You might remember circuit breakers from when the pandemic hit. We saw that the stock market started tanking very fast, and when the stock market started to tank very fast, the stock market hit a circuit breaker where all trading was stopped. You were not allowed to buy or sell stocks because the stock market hit a circuit breaker down. Well, in this case, we hit a circuit breaker on July 31st, 1914, and then the stock market was closed. Not for days, not for weeks, but for months. People were worried about what was going to happen in the world, what was going to happen in the economy, and to avoid people from panic selling, the stock market was shut down. And so right after July 31st, 1914, remember, this is a few years before the United States even entered the war, the stock market was shut down and you were not able to buy or sell any stocks on the stock market. The circuit breaker went on until November 28th, 1914. This was when you were allowed to finally start trading bonds again, and it wasn't until all the way December 15, 1914 that you could finally start trading stocks again, but there was still a disclaimer on this because now, yes, you could finally start buying and selling stocks, but you were not allowed to sell stocks for a lower price than when the stock market closed here on July 31st, 1914. So even if you wanted to sell a stock, and if you were willing to sell your stock at a loss, you were not able to. So if you wanted to sell your stock and nobody wanted to buy it, well, now you're stuck because you're not allowed to sell your stock for a loss, because this was what was going on as a way to protect the stock market from a panic. This went on all the way until April 1915, not 20, 1915, before the stock market was able to run like normal. So we went almost a year where you either were not allowed to buy or sell stocks, and where you were restricted on how to sell stocks because people were worried about the stock market, and this caused a massive dip in the value of stocks because people were worried. Let me actually show you a chart. Here's a chart of the stock market in 1915, just a little bit after the stock market first opened. After being hit hard by the shutdowns in 1914, the stock market almost doubled between 1915 and 1917, and then in 1917, that was when the United States joined the World War because the United States declared war on Germany, and that's when the stock market started to fall again into 1918. So if we put this in numbers, back in the early part of 1914, just before the war started, the Dow Jones was at right around 78. Kind of funny where it's just two digits, but this is where we were back in 1914. And then when the war ended in 1918, towards the end of 1918, the Dow Jones hit 82. So about a 5% gain between when the war started and when the war ended. But we have to remember, the United States joined the war in 1917. And during this time in 1917, just before the United States declared war on Germany, the stock market rose all the way up to 96. Remember we saw the 1914, 1915 dip, and then between 1915 and 1917, the Dow Jones went up all the way to 96, and then it went down to 82 when the war ended. So between the beginning of the war and the end of the war, the stock market grew by 5%, but the time between the United States entered the war and the war ended, we saw the stock market fall by around 15%. From after the war ended in 1918, it only took about a year in 1919 until the stock market had fully recovered and started hitting more highs. So 1919 was when we started hitting new highs in the market. Here's a different chart from Macro Trends which shows the stock market post the war in 1919 and onwards, and what you can see is that the stock market grew through 1919 and then it had a big crash in 1920 as now the United States government is working to pay off its debts, they're working to rebuild, and they're working to fight off the inflation that they faced from all the money printing to fund the war. And after this stock market crash, it set us up for the big bull market of the 1920s until ultimately the Great Depression in 1929, and you can see the massive crash in that Great Depression. World War II was a little bit different. World War II ran from 1939 until 1945, and the United States joined, we'll put this right here, US joined World War II in December of 1941. In this world war, the main countries now were the Axis, which was Japan, Germany, and Italy, versus the Allies, which was countries like Great Britain, France, and the United States. The interesting thing leading up to World War II is just like World War I, the United States economy and stock market wasn't doing too well. The United States entered a recession in 1937, and this went on until 1938. So leading up to the war, right before 1939, the United States economy was in a recession and the stock market was already going down. And if we look at the chart, what you'll see is that the stock market went down from around 1939 to the early part of 1942, and that's when we saw this massive bull market in the stock market through the end of the war in 1945. I just want to highlight that because the stock market started to turn around in the early part of 1942, and in the late part of 1941, December of 1941, that was when the United States joined the war. So if we do the same analysis here for World War II that we did for World War I, looking at the Dow Jones numbers, in 1939, in the end of 1939, the Dow Jones was hovering at around 151 points, and by the end of the war, the Dow Jones had risen to 191 points. But remember, the United States entered the war in December of 1941, so let's look at that. In 1942, which is right after the United States joined the war, the Dow Jones went down to 112 points. Remember, we were in that bear market from 1939 to 1942 because of the 1937 and the 1938 recession. That means the stock market grew by 26% from the beginning of the war to the end of the war, and from the time that the United States ended the war until the war ended, we saw the stock market grow by around 60%. And just like we looked at after World War I, let's look at what happened to the stock market after World War II, because for another year or so after World War I ended, we saw the stock market continue to rally, continue to boom, and then the effects of the war started to hit because now the United States has to start paying off its debts, it has to start dealing with the inflation, and that's when we saw another stock market crash in 1946 into 1947, and after that stock market crash, we saw a massive bull run from the late 1940s through the 1950s into the 1960s for the stock market. So now let's put the pieces together. What was the same and what was different between the two world wars when it comes to the stock market and when it comes to your money? First, on the same side, before World War I and before World War II, both times we saw the United States economy already slowing down. So we saw a slowdown before the war started. Then from the beginning of the war to the end of the war, in both cases, we saw stock market, I'm going to put that stock market growth happened in both World War I and World War II. One thing that was different is what happened to the stock market after the United States entered the war, because in World War I, the stock market went down, and in World War II, the stock market went up. So what happened after the US joined? Because in World War II, remember, we were leaving that recession, we were leaving that bull market, and then the United States declared war, and then just a few months after that, we saw the stock market start to go up, and in World War I, we saw the opposite happen. And then in both cases, for World War I and World War II, after the war was done, we saw a boom and then a bust not too long after the war ended. In both cases, it was typically around a year or 2 years after the war ended. We saw the economy boom, which then led to a bust because of all the inflation and the expenses and the debt that was racked up to fight the war. And then in both cases, this bust was then followed up by another massive boom. In the early 1920s, that's when we saw the 20s boom in the stock market up until the Great Depression. And then in World War II, it was from the 40s, late 40s until the early 1960s. Now that we know what's happened in the past, let's talk about what could potentially happen in today's economy. Now, if you do like to stay up to date on what's happening in today's finances, not what happened in the past, but what's happening right now, an easy way to do that is obviously you can subscribe to our YouTube channel, but you can also join Market Briefs, which is a free financial newsletter that we created where my team breaks down the top finance and business news every single morning. And it's a fun and easy to read newsletter. You're gonna love reading this newsletter. I promise you're gonna look forward to reading it every single morning. This newsletter, you can read it in just a few minutes every morning. It's completely free. So if you want to learn more and sign up for Market Briefs for free, all you got to do is click that link down in the description below. Right now, we're already seeing a war going on. We're seeing the war happen between Russia and Ukraine. Russia says that they already entered World War III. The United States doesn't agree. But the war is already going on overseas. Now, the United States economy here particularly is starting to slow down because we're facing an inflation problem. We're worried about going into a secondary recession being induced because of inflation, because people just can't afford our higher cost of living, which is slowing down spending, which could push the United States into a recession. Some banks say that we're going to see a recession in 2023. So we're seeing an economic slowdown, kind of like we saw happen in previous world wars, but the difference between now and previous recessions in general is that the recession that we're facing today is due to inflation, not an organic economic slowdown. Typically, when we see a recession, and we see this happen in 2008 and 2001 and pretty much every other recession that we had in our recent history, when you face this recession, the Fed creates more inflation. They cut interest rates, they print more money, they do some sort of quantitative easing, which then helps to stimulate the economy. All those things are inflationary. When the Fed pushes more money into the economy, it creates more inflation to help stimulate the economy. But the issue that we're facing today is we're entering a recession caused by inflation, which is very different than what we saw happen in the past. So economically, although we are seeing an economic slowdown, the cause of our economic slowdown is very different than what we've seen happen in the past. So I can't answer the question if we're going to see another world war or not, because that gets into a whole bunch of other geopolitical stuff that I am not an expert on. But if we focus in on the finances, it looks like our economy today is in a very different position than we were in previous recessions, not just looking at the economy before World War I and before World War II. If the United States did enter a war, that would mean that we would see a lot more government debt, we would see a lot more money printing in order to fund this war, which would mean that we would probably see a lot more inflation, which would make our inflation and our economic problem a whole lot worse. So we're dealing with a whole bunch of different issues that we didn't really have to deal with before. This goes back to Ray Dalio's theory of the changing world order, where when the world superpower now starts to face inflation, they start to face the internal conflict and they start to face the external conflict, where the internal conflict is the growing wealth gap that we have in the United States, and the external conflict is when you have countries around the world that are strengthening their military, but the internal conflict is taking away resources to grow the military and to grow the strength of the economy. That's when you can see a change in the world order. So that's a worry that Ray Dalio and a lot of investors have, is if the United States were to enter another world war and we aren't able to continue fighting like we could before, and we aren't able to fund all the operations financially, then this could put us in a very difficult situation, which we haven't had to deal with in the past couple world wars. Hopefully things will get better sooner rather than later, because that would save thousands, if not tens of thousands, if not hundreds of thousands of lives. So hopefully things get better and we don't have to worry about this, but at least now we know what's happened in the past, so that way you can make better decisions with your money today. In other words, all roads lead to investing your money is better than not investing your money. If you enjoyed this video, here's my summary of Ray Dalio's theory of the changing world order that I think you'll love. Thank you for watching, and as always, keep hustling. To understand what's coming at you, you have to understand what happened behind you. So in other words, know your history, especially when it comes to money, because history rhymes